Have you heard of Andrew Left? He's a famous short seller running Citron Research blog. Recently, the federal grand jury charged Andrew Left for fraud and market manipulation. According to the SEC, Left used bait-and-switch tactics to mislead investors and earned $20 million. If convicted on all charges, Left may spend the rest of his life behind bars. Many investors use short selling to profit when a stock price falls. There are many ways to do that, either through borrowing shares or buying put options or other arcane ways. Andrew Left is an activist short seller. You may have seen his appearances on CNBC, Bloomberg or Mad Money in the past. Left became active in short selling in 1994 when he was 24 years old. There used to be so-called boiler room scams. People would get phone calls from call centers pushing some questionable investment advice. They would promote penny stocks or some other pump and dump schemes. Andrew Left took a notice of this and went against these scams with short selling. Around 2001, Andrew Left started his own investment blog called stocklemon.com. Later it was rebranded to Citron Research. Left issues short reports on firms that he thinks engage in fraud or are overpriced by the market. If you read his reports, they're bombastic and very colorful in nature. This is unlike most Wall Street research notes that are dry and boring to the bone. Citron Research is not a financial advisor or an investment company for that matter. They're just a blog issuing short reports on companies. Here's a basic sequence of events if Andrew Left decides to issue a short selling call on a stock. First, Andrew Left would sell company A short from his own account. He would issue his bombastic reports, tweet about it, and go on TV saying that company A is terrible and will go down. He may also add his own price target. Third, the market would react to this media blitz and company's A stock would tank. Andrew Left would quickly buy back stock. This gives him a quick profit regardless of whether his report turns out to be correct or not. Sometimes Left would issue favorable loan reports on companies too. Overall, short sellers have a bad reputation. Many people just buy and hold stocks, so hearing that your stock that you're holding is a lemon does not sound too good, regardless of whether it's true or not. Also, short sellers irritate a lot of corporations, and this is especially true for corporate executives, whose stock options and reputation have been slashed by the claws of shorting bears. Andrew Left earned a lot of attention from the media with some of his calls that turned out to be right. His short report on Valiant Pharmaceuticals in Canada and Evergrande Group in China stand out. As for Evergrande, it was one of the largest bankruptcies in history. They had over $300 billion in liabilities in construction and real estate in China. Wall Street Journal analyzed 111 short sale reports of Citron from 2001 to 2014. On average, there was a stock price decline of 42% in the year following the issuance of their research. In total, 90 of 111 stocks were still lower 1 year later, while 21 stocks gained. So why and for what the US authorities want Left behind the bars? First, the SEC accuses Left that he promoted his Citron Research as a hedge fund, but in reality it's just a blog with Andrew Left trading his own money. And saying that you are a hedge fund or some investment company in the US is a big no-no. But there are other accusations. The real question becomes, did Andrew Left publish a well-thought-out report on a bad company and later quickly close some or all of his positions at a profit? Or did he use his large retail investor following to pump something and later dump without any substantive research done? The SEC complaint gives some clues. Left at some point went long on a stock called Invite Corp. He discussed with his colleague his hope to get stock to $30 and asked, what can I put in a tweet to juice it? Later, he put out a tweet saying that he was certain that Nvidia is on its way to $100 and will continue to stay long until the stock hits at least $65, as we believe it is on its way to $100. He sold that day at $27 to $28. This may seem bad, saying one thing and then doing another, and in fact it's a recurring theme in this SEC complaint. But it's not clear, though, whether this to any extent even influenced stock prices. Perhaps people buy or sell stocks based on Andrew Left's reports, but not necessarily his trading activity. But the worst part is with juicing. The SEC alleges that Left pumped these stocks through social media, only later to dump them. Well, it's a slippery slope and a gray area when it comes to investors, especially famous ones with a big following. And here's other messages between Andrew Left and his portfolio manager. Here's what Left says. I have a hot voice in cannabis. Let's take advantage of it. Left instructed portfolio managers 1 to not overthink Citron Research next target company, stating, "Stop being such a pussy. It's okay to be wrong." Yes, it's okay to be wrong, but Left wanted to use his hot voice to take advantage of it and not caring about being wrong. Later, Left showed up at the CNBC interview where he commented on a Kronos Group, which is a Canadian cannabis company trading on Nasdaq. He was repeatedly asked if he's still short on it. He replied that, well, he sold some, but he's still extremely short on the stock, and he reiterated his recommendation that the stock would go to $3.50 or below. The SEC alleges that this statement was false. Left had exited more than 75% of his short exposure at well above $3.50 by that time. The ironic thing is that Kronos actually closed at $12.74 per share the day before Left's report. Then it closed 28% lower after the report came out. But by March of 2019, the stock rallied more than 100%, only to close at $2.42 in 2022. So was Left right in his short call after all? It seems that the SEC doesn't care much about this. The most important thing for the government is that Left lied about lots of stuff. They will have to show that this could have been material to investors who listened to him. There were other allegations. Prosecutors accused Left of hiding his ties to hedge funds. Allegedly, Left gave early notice of his research or sometimes even passing hedge funds' trading ideas as his own. Often hedge funds traded before release of reports and shared profits with Left. Prosecutors also say that Left lied to the government about these connections and denied such compensation ties. At the end of the day, the case is still pending and we haven't heard Andrew Left's part of the story. This probably is a culmination, this indictment, of a multi-year government investigation into abuses by short sellers. Prosecutors were probing anything that they could find, and probably Andrew Left popped up on their radar because he's a big fish among short sellers. Also, Andrew Left is a wealthy person and perhaps he could have settled this case with the SEC and paid back some of those unfair profits. But instead, he chose to fight this in courts because maybe he thinks he's innocent. As Warren Buffett once said, if a cop follows you for 500 miles, you are going to get a ticket. It is possible that the government will struggle to convict Andrew Left. Left may show in court that he never said anything or traded on anything that he didn't believe in. But one thing seems to be clear. Andrew Left pushed too far into the gray area of what is considered legal or not. And these illegal cases will shine light on these gray areas and provide clarity for future reference. What do you think, guys, about Andrew Left and this indictment? Did Left lose his touch and credibility among retail investors, or is he good? Please let me know in the comments. And as always, thank you so much for watching and stay tuned for more videos on interesting economic and investing topics.